Welcome to the Transparent FX Academy. I'm Nick and I'm a top author on TradingView with over 190k reputation points. In this video, we will try to understand where we have the highest probabilities for a potential move on this pair. And the way in which we will be doing that is first, analyzing the pair from a technical perspective. Then we will go and see what we have when it comes to the commitment of traders, which is what hedge funds and the non-commercials, so the biggest speculators in the market, are doing. So without wasting any more time, let's go straight to the charts. Okay, so let's make a full breakdown of the situation that we currently have on gold. Now, starting here from the monthly, what we can see is that the market at the moment is starting to fill in the wick that we can see that we had created with the previous monthly candle. Now, as I said many times, when you see a candle like this with a very long wick and a green body, usually the next candle fills in the wick. Now, if you're asking yourself, why is that? That is because when you have an impulse and a correction on lower time frames, for example, the weekly, on the monthly, you will see a candle like this, in which the correction is exactly the wick that we see here from a monthly perspective. And in general, after an impulse and correction, you expect another impulse to the upside for the completion of the pattern, establishing an uptrend. So the creation of an uptrend on the weekly usually forms candles like this on the monthly time frame. So from a monthly perspective, we do expect the wick to be filled. Dropping down on the weekly, what do we see? Now, from a weekly perspective, we can see, in fact, an impulse and correction. And in general, after an impulse, when you have a correction and you want to measure it, what you have to do is take your Fibonacci from the low to the high of the impulse. And if we do that, we can see how the market here has just retraced exactly to the 0.786 of the Fibonacci taken on this weekly impulse, which is a quite strong level of support and demand, which the market just tested, and from which we could expect a potential rejection higher. Dropping down on the daily time frame, what do we see? Now here on the daily, we can see how in creating this move to the upside, the market is also printing in overextended W formation. Now, in general, after the creation of an overextended W, what you want to see is the market create a correction at least to the 0.382 of the Fibonacci taken on the daily impulse. Now, in this case, the daily impulse is from this low to this high. So if we take our Fibonacci from this low to this high, we can see that we have a first downside target at this 0.382, which is at the moment at this area. And if we look closely, we can also see that this 0.32 is currently lining up with this area of previous daily resistance, which is now turned support here. So an area that, once again, we could expect this market to go and test before then rejecting it to the upside, because clearly we do have strong demand and support here and also strong liquidity. So definitely a potential downside target here for the completion of this overextended W. But as we have already seen on the monthly and weekly, overall, we do expect more continuation to the upside. So what we have here for gold is a potential short-term shorting opportunity back to this area, and then from here a longer-term longing opportunity for the continuation to the upside. Now, if we go and see what we have when it comes to the commitment of traders, so the COT data, which is what the non-commercials, so the biggest speculators in the market, are doing, and we check the data specifically for gold, what we can see is that in the long term, we did see an increase of the net positioning. In fact, we went from having 172k net positions all the way up to having 245k net positions, with currently 324k longs compared to 79k shorts from an institutional perspective. However, it is important to point out that in the short term, we are actually seeing a decrease of the net positions from 274k to 245k, with in fact 8.9k shorts added with the last report and 3k longs getting closed. So in the long term, we are seeing longs increased and shorts decreased from an institutional perspective, but in the short term, we are seeing shorts increased and longs decreased. Well, that correlates perfectly with what we have already identified from a technical perspective, because we have already seen from the technical side that we would like to see a short-term shorting opportunity and then a longer-term longing opportunity. So how we could be approaching this situation. Now, as usual, trading is reactive and not predictive. The monthly, weekly, and daily combined with the COT data, those are the best timeframes from a directional perspective. However, when it comes to confirmations and entries, the best timeframes are the intraday timeframes, so 4 hour and lower. Therefore, what we could be doing is monitoring price action from an intraday perspective during this move to the upside, waiting for the market to shift from an intraday bullish environment as we have right now to an intraday bearish environment. And if the market would shift from an intraday bullish to a bearish environment, at that point, we could be looking for the potential move to the downside and completion at this level if the market would provide to us one of our valid entries. Now, if you don't know what I'm speaking about when I say market environment shift and valid entries, that is all part of the mentorship program, which you can now access completely for free. In fact, the link is in the description, and I really suggest that you go and check it out because you can learn all the rules of the strategies and you will find a lot of valuable content inside of it. Now, if you enjoyed this video, also make sure you smash that like button and comment below. It really does support the creation of more free education analysis for all of you because obviously it helps with the YouTube algorithm, and I will see you in my next video.